You're listening to the Shaughnessy Group podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Welcome back to the deep dive. Today we are tackling what is probably one of the biggest events in an entrepreneur's life, selling their business, specifically selling it here in Canada. And it's so much more than a transaction, isn't it? It's often the single largest financial decision you will ever make. And for our source material today, we have something pretty incredible. It's a comprehensive list put together by top Canadian financial experts of the 61 essential questions that business owners, that you must know the answers to before you even think about selling.
Yeah, and that number alone, 61 questions, it tells you just how complex this is. It's a roadmap of all the critical concerns unique to the Canadian landscape. We're talking tax laws, legal nuances. It's just a different world up here.
So our mission today is to give you a shortcut through that maze. We're not going to hit all 61. You'd be here all day.
No, we're going to group them. We'll hit the big themes: strategy, valuation, structure, and then, the actual execution. Think of this as your focus guide.
Okay, let's do it. Where do we start? The absolute foundations.
Exactly. Before you even talk to a single buyer.
So let's kick off with that first big theme, strategy. The number one question on this list is, what exactly is an exit strategy, and why do I need one? It feels a bit like selling a house, right? You don't list it before you fix the leaky roof.
That is a perfect analogy. An exit strategy is all about readiness and timing. The list has questions like, is now the right time to sell? And how do market conditions affect my price? If interest rates are high or your whole sector is in a downturn, your timing has to be strategic. Can't just be because you feel like retiring.
And what about internal readiness? I mean, beyond the market, the source material really pushes on this. How do I know if my business is ready? What are the first steps?
It so often boils down to a couple of things. First, cleaning up the books. A classic mistake we see is owners running all their personal expenses through the company.
Oh, the car lease, the cell phone.
The cottage utilities, you name it. Buyers want to see clean, repeatable earnings. If your financials are a mess, they just assume there's something else you're hiding, and they will either walk or they'll slash the price.
So untangle your personal life from the business. What about other internal issues? Like, what if I have a business partner or debt?
Huge friction points. For partners, the sources are clear. Can my partner sell without my consent? You absolutely need a crystal clear, updated shareholder agreement before you go to market. Otherwise, one partner can absolutely kill the deal.
Wow, okay. And the debt?
The question is usually, can I sell a business with debt? And the answer is yes. But that debt gets settled from the sale proceeds. It's not the buyer's new problem. It just means less cash in your pocket when you close.
That feels like a minefield of deal breakers if you haven't done that prep work.
It is. The big takeaway from this whole strategy phase is this: plan early, clean up your books, and sort out your internal hurdles before a buyer ever walks in the door.
Okay, foundation set. Now for what feels like the hardest part for any owner. The price. How do I even begin to calculate the value of my company? And, what's a realistic number?
This is where it gets into the hard numbers. And every owner wants a simple formula. But the truth is, valuation is really more art than science. The sources stress that you have to know the three main valuation methods used in Canada.
All right, let's break those down. What are the big three?
Okay, so first is the asset approach. It's simple. You just add up all your assets, subtract the liabilities. It's fine for a factory, maybe, but not so great for a service business.
Right, because the value isn't in the chairs and desks.
Exactly. The second is the income approach. This is usually the discounted cash flow method. You predict future earnings and then calculate what they're worth in today's dollars.
And the third?
The third, and this is the most common for small and mid-sized businesses, is the market approach. You look at what similar businesses have recently sold for and use those multiples.
Ah, the multiples. That's what you always hear about, the X times earnings number. So if I'm a small business owner, should I focus more on a revenue multiple or an earnings multiple?
Great question. Generally, earnings matter more. We typically look at a multiple of EBITDA. That's your earnings before interest, taxes, depreciation, and amortization.
Why not revenue?
Well, a revenue multiple only works if your profit margins are solid and in line with your industry. I mean, you could sell for 2 times revenue. But if you have terrible margins, that valuation is it's meaningless. The real value is in the profit.
Which brings us to the question every single owner is thinking. How can I sell my business for more than it's worth?
Right. How do you maximize that value? It's about de-risking the business for the buyer. It's not about your past profits. It's about proving future profits.
So making the business less dependent on you, the owner.
100%. If you can show them a strong sales team, documented processes, basically a machine that runs without you, that's where you get a premium valuation. You have to think like a buyer.
Okay, so we've got a strategy, we've got a valuation. Now for the part where, you said it, this gets really interesting, the structure of the deal itself.
Yes, this is where a good sale becomes a great life-changing sale, especially with Canadian tax law.
And the biggest choice here, according to the source material, is should I sell my business as a share sale or an asset sale? That one question has massive implications, doesn't it?
Enormous. It basically comes down to who pays the tax bill. The general rule in Canada is simple. Sellers want a share sale. Buyers want an asset sale.
Okay, why the difference? Break that down for us.
So in a share sale, you're selling the whole corporation. Everything. The good, the bad, the ugly. For you, the seller, the money you get is a capital gain, which is taxed at a much lower rate.
And an asset sale.
In an asset sale, the buyer just cherry picks the assets they want, the equipment, the client list.
Right.
And they leave the old corporation and all its liabilities with you.
Yeah.
The money you get can often be taxed as regular income. Much, much higher tax. And this leads us to the golden ticket for Canadian entrepreneurs, the Lifetime Capital Gains Exemption, the LCGE.
Okay, explain this because this sounds like the aha moment.
It is. The LCGE lets you shelter a huge chunk of your capital gains from tax when you sell shares in a qualified small business. We're talking around $900,000, completely tax-free.
That is literally hundreds of thousands of dollars in your pocket.
It's the difference between a good retirement and a great one. And it's why you, the seller, will fight tooth and nail for a share sale.
But to pull this off, you need professionals. This isn't a do-it-yourself project.
Oh, absolutely not. The list asks, what role does a lawyer play and what does the accountant do? The lawyer structures the deal to protect you. The accountant makes sure you actually qualify for the LCGE and plans the most tax-efficient structure.
And what about the boring stuff, like what happens to my office lease or my big customer contracts?
Not boring at all. It's crucial. Those are standing obligations. The buyer needs clarity. Usually, contracts have to be formally assigned to the new owner, and that means getting consent from your landlord or your client.
Right. And cash. What happens to the cash in the bank?
Good question. It's usually stripped out by the seller just before closing. A buyer isn't paying for the cash you have in the bank. They're paying for the machine that generates future cash.
That makes sense. Okay, final phase, execution and logistics. The eternal question. How long does this all take?
Everyone wants it to be fast. But a properly managed sale takes 6 to 12 months. Anything less, and you're probably leaving money on the table.
And finding that perfect buyer, that seems like a huge challenge. How do you do it?
Most serious sales happen privately, through advisors or brokers. The question, should I partner with a business broker, is a big one. They don't just list your business, they manage the entire confidential process.
But they're expensive, right?
Yeah, they are. Fees can be 8 to 12% of the sale price. But they earn it by finding qualified buyers and keeping the deal momentum going while you run your business.
And if you don't use a broker, confidentiality must be a nightmare. You're showing your most sensitive info to potential competitors.
It's paramount. You use rigorous non-disclosure agreements, NDAs, for every single person who even looks at your books. And then the due diligence phase. You just have to be prepared with meticulous, organized documents for everything.
Okay, so the deal is signed. We're not done yet, are we? There's the transition.
Not at all. You need a succession plan. You have to prove the business can run without you. That's part of what the buyer paid for. And you need a plan for your employees. Are they staying? Do key people get bonuses to stick around? Clarity is everything.
And what about this thing called seller financing? I see that on the list. Is that common here?
Very common. It's where you, the seller, agree to finance a portion of the purchase price. You become the bank for the buyer for a little while. It helps get deals done and shows you have confidence in the business's future.
So let's bring this all together. The complexity here is just, it's staggering. From the strategic planning to the valuation math to the absolutely critical difference between a share and an asset sale.
Right, which is tied directly to the lifetime capital gains exemption.
It's just so clear that trying to find answers to these 61 questions by yourself, just searching online, is a massive and frankly a really unnecessary risk.
That is the key takeaway. Selling a business isn't a transaction. It's a comprehensive transition. And here's a final thought for you to chew on. Most owners spend decades perfecting how to run their business. But how many spend even one solid year perfecting how to sell it? That preparation difference is what determines your ultimate payout.
That is an excellent point. A huge thanks to Shaughnessy Group for providing these insights into the critical questions Canadian business owners are facing. For those of you ready to leverage that kind of proven expertise rather than spending hours trying to figure it out online, we really encourage you to visit their website for more resources and consultations. It's shaughnessy.group. We'll be back soon for our next deep dive.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.